Right, students, it is time for another video lecture, and today we will be looking at tax and the incidence or burden of tax. And we'll kind of get into more detail on what that really means in a little bit. But let's go ahead and get right into it. Before we get started, I don't know where I got this PowerPoint template from. It was a gift from another teacher. If I knew who made it originally, I would definitely give them credit. I have modified it substantially. But anyway, just kind of mentioning that. Anyway, so let's go ahead and get into it. Our learning goals for the day. 1, by the end of the day, you should be able to define indirect tax and differentiate its forms. 2, you will be able to identify tax incidence, and you will not only be able to define it, but you will be able to show on a diagram where it is, and we'll look at that more closely. Finally, you're going to examine the steepness of the curve of demand, or the price elasticity of demand in relation to that tax incidence. So you'll know, if based on the PED of an item or PES, who will be paying more of the tax. We'll get into that in just a moment, but let's go ahead and get started. And just to kind of mention, we're talking about indirect taxes. This is different than direct taxes. Direct taxes are taxes that are taken directly or levied directly upon income. So an income tax would be a good example of a direct tax. It's kind of like when the government takes money directly out of your check. That would be an example of an income tax. Now, that is, again, it's taken directly from you, so direct tax. Indirect tax is where the government takes money basically they're taking money from you, but not directly from you like a direct tax. They usually ask a business or a retailer to charge an additional fee onto an item, and then a business will charge that fee, and then they will send that money to the government, the additional fee. And that's why it's called an indirect tax, because it's not taken directly from you. The business takes it from you, then gives it to the government. And so basically we define indirect tax as taxes levied on expenditure or taxes on spending. A good example of this in the United States or maybe Britain would be called a sales tax. In Germany, I believe we call our sales tax a Mehrwertsteuer, if I'm not mistaken. And so these are just examples of indirect taxes and kind of what we're going to be looking at today. So the first type of the two types of indirect tax is called a specific tax or a flat rate tax. And basically that's just a per unit tax. You can find you will find that this is the typical diagram when you think of a tax, and you've already made this diagram and you know what it looks like. This is nothing new, but we'll still touch upon it again. So that's a flat rate tax or specific tax. The other type is called an ad valorem tax, sometimes called a value added tax, and this is not a per unit tax. It is a tax that is levied as a percentage, and so it looks a little different on the supply and demand curve. Let's go ahead and get to it with the diagrams. We said that the first tax is called a specific tax or a flat tax. What that means is it's a per unit tax. So basically what it's going to do is it's going to make the price of the good more expensive by the amount of the tax at every given quantity. So for example, if an item costs $10, whatever quantity $10 used to buy, now you need $12 to buy that quantity. And basically again, it shifts the supply curve upwards at all quantities by 2 euros or $2, whatever the currency is that you're using. So again, it's parallel to the existing supply curve. It's pretty easy to make. Just note that this is the kind of tax that we're going to be talking about for most of the lecture, but so just kind of keep that in mind. Usually too on IB tests, most of the taxes that are sort of asked on questions are specific taxes or flat taxes. Okay, let's move on. So an ad valorem tax is a little different. It's levied as a percentage. So when we think about that, the tax, since it's levied as a percentage, looks a little different. It kind of becomes steeper as it gets further, as the price goes up, it gets further away from the original price curve. And there's a reason for that. Take, for example, let's say an item was 10 euros, and the government decided to issue a 30% tax. Well, what's 30% of 10? It's 3. So your final price would be 13. So the distance between the 10 and the 13, and the two curves would kind of show you that at the price of 10, the new price is 13. However, what if the price was 11? Would it be the same distance between the supply curves? Well, no, it wouldn't, because 30% of 11 is not 3. It would be 330. So the price would be 1330. So it would be a little bit further distance between these two curves. So just note that if ad valorem tax looks just slightly different, and it gets further, as the price goes up, it gets further away from the initial curve. So those are the two. We've met our first little goal. We've gone over what is indirect tax and what are the two forms. But the next thing we need to learn is we need to look at the incidence of taxation, and we need to look at why taxes are collected, and look at the government revenue earned from those taxes. So let's take an item that is traditionally taxed. We'll say tobacco. Tobacco is usually taxed at around 4 euros. Or no, sorry, the original price, let's say, is 4 euros. And the government decides to levy or put a 2 euro tax per unit tax on all packages of cigarettes. Well, what will that do? Well, we'll shift the supply curve. Again, and this is the diagram before the initial shift. The government issues that tax, and one of its main objectives there is to get people to, not only buy less, but the government gets money from this, and they use this money to spend on government programs. So let's go ahead and take a look at how much the government's getting when they issue this type of tax. So we're going to shift the supply curve by a unit of 2 at all points. So again, you can kind of see that the previous equilibrium of 4, that price of 4, now the supply curve is closer, at that same quantity, it's closer to 6. So the supply curve has shifted. And we have a new equilibrium price at 5. So again, even though the tax was for 2 euros, because supply and demand work together in establishing price and quantities, it doesn't make the good necessarily 6 euros. Depends on the steepness of the two curves, and we'll talk about that later. But so now the equilibrium price is 5, and maybe, I'm sorry, the quantities are all off a little there. It's supposed to say the previous quantity is 30, and the new quantity should be 20 for, with the issuance of this tax. So anyway, let's we can see that the price has gone up, the quantity has gone down, and yeah, and I want to show you something real quick. If you were to make a box kind of where that purple outline is, or the purple box is, and it's pretty easy to make this box. All you do in making this box is you find the new equilibrium, draw a line from the new equilibrium over to the price axis, or the y-axis, that is parallel to the x-axis. So you're basically drawing a straight line over to that number 5. Then you're going to do another line, or dotted line, down to the new quantity, and make it go all the way down to the x-axis. Then make a dotted line from where basically where the dotted line that you just made that intersected with the previous supply curve over to the y-axis. So then finally make a line. Actually, you could stop there. So basically, just make the purple box is what I'm asking you to do. And that purple box is the government revenue. If you wanted to figure out what that government revenue was, you would take the price of the new price, 5, and basically what you have to do is you have to find the size of the box. So it would basically be 2, right? The distance between the 5 and the 3, so 2, and then times the quantity. And it didn't quite work out that way, but the quantity was supposed to say 20, so the government revenue would be 40 in this case. Let's move on. So in the last example, we saw that there was government revenue that was created because of a tax. And when that happens, the thing is, part of that tax is paid for by the producers, and part of that tax is paid for by the consumers. This is called tax incidence, and we're going to go ahead and look at who is paying what portion of the tax. So kind of like the last diagram that we just saw, we're going to draw a line over from the new equilibrium. We're going to draw a line down to the y-axis or the x-axis. And basically when we do that, previously, we made that purple box that showed the government revenue. Well, that purple box, part of that box is paid for by consumers and part is paid for by producers. This is the tax incidence. And when we do that, please note that the consumer share is basically kind of the upper half of that box, and the producer's share is the lower half of that box. So again, the tax revenue that is taken by the government was that purple box in the previous slide. When we look at who's paying what, producers and consumers, of that tax, you can see that it's, in this case, it looks like the consumers are paying just a little bit more than the producers. But together, they're paying the tax. So anyway, let's move on, and let's go ahead and look at the incidence of tax at different elasticities. So here in this diagram we have a really inelastic demand curve, meaning it's very steep, that consumers don't adjust to prices much. Something like cigarettes would be a good example actually, because they're addictive, so you'd have a really steep curve. So let's say we shift the supply curve up because of the tax. We're going to kind of make those same boxes that we just made. And you can see that if it's an inelastic curve, like cigarettes or maybe alcohol, anything that's addictive, the consumer share is substantially larger than the producer share. I would encourage you to pause and try to make this diagram so you have a copy as well. Let's move on. What if it was really elastic demand, meaning that consumers really are price sensitive, and the price went up because of a tax to P2? Who would be paying more of the burden of tax? Well, I think you can probably already see, and if you think about it as well, the last example, it was really inelastic demand. The consumers paid a lot of the tax. In this example, the producers are going to be paying more of the tax when you have a really elastic demand curve. Let's move on to another example. What about supply? What if you had a really steep supply curve or an inelastic supply curve? Who would be paying more of the tax? Well, we're going to make our little boxes, and you can probably guess it is going to be the consumers that are paying very little and the producers that are paying a lot. Finally, our last example, what if we had a really elastic supply curve? Who would be paying more? And in this case, as you can probably tell, it's going to be the consumers. There's the consumer share, there's the producer share. And again, this is the incidence of a very elastic supply curve. All right. So here are kind of all the curves together, and you can kind of see the burden of tax based on the steepness of either the supply or the demand curve. And one thing you should know is that the government tends to want to tax goods that have one inelastic demand. Why? Well, if you notice that the quantity shift on something that is inelastic is not very substantial, whereas the price shift is very large. So when you look at that top left example, you can kind of see that the quantity of whatever good that is has not diminished much, meaning that the producers are selling a smaller quantity and they're not making as much money, but they're still selling quite a bit, and it's pretty close to their original price. If it was, for example, if you look at the box on the right where it's really elastic demand, the quantity has dropped substantially. Producers are losing a ton of money because they're selling a very, very vastly different amount of units. And so the government knows if they tax something that's got really elastic demand, you may kill that company and they may not survive that tax. So the government has to be careful with what it taxes. And we also have to ask the question, does the government tax because they want money or because they want us to stop doing it? You know, when you look at, for example, cigarettes, the taxes aren't high enough to really get people to stop. They discourage them, yes, but they aren't enough to put all the tobacco companies out of business. And that's probably for a reason which we will have to discuss in class. Bring your tissues, you might cry. Anyway, so moving on, let's just look at a couple more things. Let's look at the loss, efficiency loss, or deadweight loss from a tax. Before tax, we had consumer and producer surplus maximized. However, the government decided to come on in and give us a tax, shifting supply to the left. What happened to some of our producer and consumer surplus? Well, now this is the quantity, this is a new price, so the quantity demanded is lower. So guess what happens to the consumer surplus? It gets smaller. Also, because even though the price is higher, the producer isn't getting some of that money. The government's taking it away from them. So basically, we have some different boxes here, or some different triangles and boxes. Box 1 is obviously the loss in consumer surplus. Boxes 2 and 4 are going to be the revenue to the government. Box 6 is the new producer surplus, and 3 and 5 is the deadweight loss. So again, 2 and 4, government revenue, 3 and 5, deadweight loss, and 1 and 6 is the new producer and consumer surplus. All right, let's move on. Subsidies are kind of like negative taxes. Basically, it's the government giving money to firms. The definition of a subsidy is basically a payment from the government to encourage the production of a good or service, or you could say it's also to lower prices and increase quantity. We're going to do a flat subsidy, kind of like a flat tax. Basically, if the government just gives a company money, you're going to shift the supply curve now downward by that amount. So you just pick a point and you would draw, whatever the amount is, you'd make the supply curve lower now, or I guess you would say it would increase at all given points. So if the subsidy is, we don't have defined units here, but you would draw it that much lower, and that would be your new supply curve. Price would go down to PB, and quantity would increase to Q1. So anyway, we're going to go ahead and stop there. That's our video lesson. I hope this helps you, and I hope that you can define what is a indirect tax. That was one of our learning goals. What are the two types? Which one is the tax as a percentage? You remember? Ad valorem. And also, can you identify the government revenue, and can you identify the incidence of on the demand curve of both the producers and consumers? Anyway, I've tried to make this as quick as possible. I hope this helps. Good luck, and we'll see you soon. Bye.